according to our next guest, market-rattling tariffs maybe offer one upside. Companies can use the shifting financial landscape to adjust their performance goals, calling the current macroeconomic uncertainty a free hall pass for the tech giants. Joining us now is Brent Thill, senior analyst at Jefferies. Brent, there's a lot of negative stuff to say, so I thought I would start with something a little bit more silver lining-ish, I guess, a silver lining of a sort, which is that maybe this whole situation is air cover for companies to say, okay, we're not going to give you a forecast or we're going to reset things. What are you expecting to hear from big tech as we get into earnings? Brent, you hearing us okay?
If CFOs keep guidance, if companies keep guidance, we're going to effectively see stocks go lower. So what we're advocating is most tech companies just guide to more conservative outlook. And investors want to buy that dip, right? We have many of these tech stocks off 20 to 40, 50% in some cases. So CFOs have a hall pass to lower the numbers. Institutional owners have seen multiple compression. The only other thing that can compress are numbers. So effectively just take a haircut to some of the numbers and you effectively will have a better backdrop for tech investors to want to buy stocks. So one of the things we keep hearing back from institutional investors is, I got to hear numbers going lower, maybe capex a little lower, and I feel more confidence that I can buy this dip.
Brent, I would assume, given the very smart, grizzled financial analyst that you are, Brent, that you are doing your checks on your own companies. You're out there doing your field work. Generally, what are you hearing, Brent? Are you hearing, is it caution? Is it raw panic? How would you describe it?
More drama than the ending of White Lotus. So it is pretty gnarly. And what I'd say is, like, you hear things all over the board. Some are not seeing it yet. Some are saying it's coming. We had one advertiser say that he expects kind of everything to kind of grind to a halt in the middle part of the year as advertising budgets can turn off. So, he saw 15% growth at meta budgets last year. He's seeing 0% growth this year. So, it's kind of all over, and it's what you would expect, which is we haven't seen it yet. It really didn't have a huge impact on Q1. It has a bigger impact in Q2. Then the question is, like, what's the range of the tariff outcomes? And I think that's the thing none of us know. And so because we don't have any certainty, everyone's waiting to see and waiting to buy post-April, May earnings. And most of our clients are doing nothing right now. They're not buying, they're not selling, they're just waiting. Now, if you ask our tech desk, 50% of the pain has been felt. And so we still feel like there's more downside. We cut numbers across the board Monday across 30 software names, and then we ran trough multiples. And that suggested at the midpoint another 15% downside as of Monday before the market. So I still think right now we just don't have a lot of conviction. But I think, again, we're getting nearer, hopefully, in the second half of this pain versus the front half. And again, I think that's good.
Yeah, you called it in a recent note a mullet year, business in the front, party in the back, I guess. Like the second half of the year could be better. What's going to fuel that better? Is it that you're going to see these companies cut and have that reset? Is there actual good news coming down the pike, or is it more an absence or alleviation of bad news?
I think you have three things. You have multiple compression already, so that's good. That's gone. That's already getting put into these stocks. Second is you get number cuts. So we get number cuts and multiple compression. That yields lower price targets on stocks. We've already done that across the board. Getting the rest of the street to take numbers down, right? We saw a couple other tech firms bring numbers down across the internet today. That's healthy. So everyone's just got to keep taking numbers down. I think the tariff component, which is, how hard is the government going to back off? At some point, everyone knows we were going to go in hard. And I think everyone we talk to in the political field says that there's going to be a softening. No one really knows to what degree. And then how long does this sit? I guess I was surprised to see, 3 days of golf post all these issues. I think everyone was shaking their head, like, doesn't seem like there's any urgency to want to back off from what we saw. So I think it's kind of what most strategists felt like, which is we'd come in hard, and then it's really just it's a macro driven now for tech. And so we're all having to put our macro hats on, and we're taking our tech hats off.
Brent, when you're talking to clients right now, if they ask you, all right, so break it down for me, what are the names that you see as, relatively defensive, large caps, favorable risk reward here? You tell them what, Brent? What would be some examples?
Meta close to a low on multiple. Microsoft high recurring revenue. No corporation's going to cut their Microsoft spend based on what they're seeing. And look, no one's immune, so I don't want to sit here and say anyone's going to fly through this. But many of these stocks are off. I mean, Microsoft's off 15%, right? Amazon's off 22%. So we like Amazon here in terms of the durability. You're still going to buy deodorant and shampoo. You may not go to the Masters this year because I heard the tickets doubled from Monday to today. So that may not be happening at the end of the week like I thought. So you're still going to go back to basics, right? And I think we're seeing, those names that provide those basics around their cloud compute, around core components that drive our households and business environments. Amazon should be in a better spot. And again, it's already taken a big brunt of the hit. I like the bigger platforms. I like the large caps. I think the small and mid caps, we could have way bigger variations on outcomes because they don't have that type of durable mosaic of portfolio across the globe. So yeah, that Amazon's at risk because of some of the tariffs, but ultimately you are going to trade down. You're still going to buy the basics. So I like Microsoft, Meta, Amazon. And then in mid cap, I'd highlight some of growthier names. Once this clears, companies like Monday.com, MDNY, and then Procore, PCOR. They power the global construction industry, infrastructure, roadways, power plants, sewers. They're still going to get built. And Procore is the collaboration software that enables the construction world to come together and build this effectively. And the last name I'd say is Roper, ROP. One of the best management teams. I've said if my kids went to spend the weekend with the CEO, they come back better than if they hung with me. I'm a huge believer in the management and the quality of this franchise. It's 28 companies in one that you owning one stock, which is ROP.
One more question, kind of come back to the reset that we might get from these companies, specifically with regard to spending. All these big infrastructure, AI spend plans, capex spend plans that we heard about earlier in the year. Do investors want them to cut those? Is that a good thing or a bad thing? Do you think they're going to be cutting some of those plans?
It's still an AI race, and we were just at an Oracle data center in Salt Lake last week, and they can't get enough supply of products, and they can't build the buildings fast enough, or can't get the energy fast enough. I think some of these Microsoft cuts are not just because AI is done, it's just they're optimizing where their dollars go, and I think that's smart. And maybe they have an indication that the economy is starting to soften. And so I think everyone's been freaking out. If Microsoft cuts, what happens? And cash flow is going to go higher, right? We've been in a massive capex spend environment. So if you're a software investor, you want capex to be cut. If you're a semi investor, you're running for the hills if capex gets cut. Right. And so I think it depends on where you're at in tech. I'm a software guy. I think everyone wants capex cuts to start. I think I've said this repeatedly. Microsoft and others are starting to pull back the throttle a little bit. They publicly indicated they're not going to be spending as much next year as they did this year. And everyone's freaking out on every data point right now. So I think it just tells you everyone's in these names. We're too overweight on some of the infrastructure. Everyone's been in AI infrastructure. I think this AI trade goes to software. So a capex cut would be good for software. It would not be good for anything in infrastructure. So look, the problem is Meta just raised guidance in capex. We got a raise from all the others. Our capex went from $300 billion to $350 billion. And so the only one I see right now really pulling back is Microsoft. They publicly said that it's going to go, capex will equate revenue growth and not grow at 97% like it did last quarter. Mm-hmm. So I think overall, yeah, it depends on what side you're on in tech. It's really scary if you're an AI infrastructure vendor if these guys pull back, because those stocks are going lower if they do.
You know the headline for me out of this one? Brent Thill, it's gnarly.
It's gnarly.
I think that's
for me, it was more drama than the White Lotus finale.
Also, sub-headline. Very well. Brent, always good to see you, my friend. Thanks for joining us.
Yeah, thanks for having me, guys. Take care.